Hello everyone and welcome back to this fantastic session on derivatives for CFA Level 1. Now if you read the title, it is application of options theory to corporate finance. Now when the exams near, students often come to me and tell me that sir, ये नहीं समझ में आ रहा है, this is little confusing. How can we apply this option theory over corporate finance? What all is given in the book we really don't understand. It is shareholders position as a long call, or alternatively the shareholders position is long the put along with long the underlying. How all this is going to work? This is little confusing. Please make us understand. थोड़ी help कर दो सर यहाँ पर. So what I always tell students that do not get confused with the terminology. Just use your simple understanding. Just use your simple understanding. Forget options, forget call, put, forget derivatives only. Let us build a scenario where you want to buy a company. So I'm giving you a situation. Imagine you want to buy a company and company's assets are rupees 100 crores. That means if you want to buy that company, you have to pay rupees 100 crores. But do you have that much money? You have only rupees 20 crore. If you have only rupees 20 crores, somewhere you will have to use leverage. Financial leverage is what I mean. Financial leverage means including borrowing in your capital. So in your capital structure, when you have infusion of borrowings, that becomes a levered capital or geared capital, and that is how you will be able to invest into these assets. So let us assume what is the shortfall that we find over here, that is rupees 80 crores, right? So remaining rupees 80 crore is borrowed from a bank. So now you had your own money, rupees 20 crore, you borrowed from bank rupees 80 crore, total money you have employed in buying assets of a company worth rupees 100 crore. The question is, who owns this company? Correct? Who owns this company? So obviously you are owner of the company, but if something goes wrong, who will have the first claim on the assets of the company? Because when you have invested your own money, it behaves like equity. Correct? When you have invested your own money, it behaves like equity because you will be the shareholder. So you as an owner are equity, and the bank, which is the debt provider, will always have the first claim on the assets of the company. So who actually owns the company today? If we ask, we will always answer this as bank will always have the first claim and shareholders will take the residual. Shareholders will take the residual. Now this is a fact. Now what? So one day there will be maturity of this loan which will arrive. Let's assume that you have paid interest on the bank loan up to that date. So if you have paid interest on bank loan up to that date, correct? You have paid interest on bank loan up to that date. What is outstanding is the principal amount, that is rupees 80 crores. So rupees 80 crore is outstanding, and let us now consider two possibilities that may exist. Let me shift myself. Case 1, where assets that you are having, which were initially 100 crore, these assets have grown to 150 crore, possibly because of the profits that company has earned. Second alternative could be another case where the company would have suffered the loss and 100 crores worth of assets have now come down to just rupees 50 crore. Now these two possibilities exist. Now what I'm going to do, I will not be in a position to give you any time to write down anything. So you can quickly take screenshots if you want, so that you can take this understanding, take this example as a follow-up thing. So just take the screenshot and I'm sure you are clear up to this part. So we are dealing with these two cases now. Assets become rupees 150 crore or assets become rupees 50 crore. Moving ahead, when we deal with the first case, that is when the assets become rupees 150 crore, will you be able to pay off the entire outstanding towards the bank loan? Of course, yes. So out of 150 crores of assets, because the due date or the maturity date of that loan has arrived, by far you have been paying only interest. The principal remained outstanding throughout. Rupees 80 crore you can comfortably pay, and the remaining 70 crore you can retain as shareholders value. Keep in mind, equity will always have the residual interest in the assets of the company. So assets of the company, bank has the first claim. When I'm saying bank, I mean the debt provider or the bond holder. If the company has raised debt by issuing bonds, bond holder will have first claim, equity holder will have the residuary claim. Now, what about the second case? Assets of the company are only rupees 50 crore. Now what you will do? The question is, can shareholders pay rupees 80 crore to the bank? They don't have that much money, right? Due date has arrived, bank is demanding its money, but the company has suffered with losses. So what can be given? Company will be wound up, correct? Bank will take over the entire company. So answer to this question, what do you think? Will it be yes or no? Can shareholders pay entire rupees 80 crore? Can they pay? The answer is no, they cannot. Why? See, owner has suffered the loss. The real owner was the equity holder, which in this case I have made you as the owner of the company. So can you be asked to bring that shortfall of 30 crore from your personal assets? Can you do that? The answer is no, you cannot be asked to do that, because we follow a concept of limited liability when it comes to a company. We always say company as X company limited, Y company limited. The objective of putting the words limited is to indicate that the shareholders have a limited liability. The liability of shareholders is limited to the extent of paid up capital only. They cannot be asked to pay anything beyond that, because the shareholders have already fully paid the amount of capital that was rupees 20 crore initially. They cannot be asked to pay anything beyond that. So bank takes over, shareholders walk away. So shareholders won't get anything, they just walk away. The loss is not going to the limit of 50 crore. The loss is going only to the limit of 20 crore of the capital contributed by the shareholders. Why I am saying that loss was 50 crore? Simply imagine, when you started the business, the assets worth 100 crore was the starting point. Today the assets are worth 50 crore. So that means you have suffered with a loss of 50 crore. But shareholders won't absorb that entire loss of 50 crore. They will be having their liability only to the extent of the paid up capital. That means they will absorb the loss of only 20 crore. Balance loss will be borne by the bank. So in the situation where assets were 50 crore and debt were 80 crore, can bank force the shareholders to contribute another 30 crore from their personal wealth? We have already answered this question, that no. And why no? Because we are following the concept of limited liability. Let me enhance the screen for you so that you can see that last line properly. So that is exactly what we call as limited liability. Without limited liability, there is no option analogy. That means if you are trying to attach the concept of options in corporate finance, you are not going to do that without the concept of limited liability. I have allowed this moment for you to quickly take the screenshot of whatever you find on screen, and then I take you ahead. Now, when the assets became 150 crore, did the shareholders choose to pay in full? Obviously, yes, they chose to pay in full. When the assets become 50 crore, did the shareholders choose not to pay in full? Yes, they indeed make a choice. Now wait, what is happening? What is happening over here? In both scenarios, the shareholders are making a choice whether they want to pay in full or they do not want to pay in full, because they cannot be forced to pay the entire amount if they have suffered with a loss. Whatever is remainder with the company's assets, that can be utilized to pay off the debt. That means in both cases you are making a choice. You are making a choice. The question is, are you having just the right or are you having an obligation over here? They had a right, not an obligation, because both questions have been answered as yes and yes. So in both cases they have exercised this choice, and this is exactly like a call option. So now what is the fundamental question? Why are we calling equity as long the call? That means why equity is considered to hold call option. Long call means holding the call option, owning the call option. Let us understand this point very well. The exercise price of this call which the shareholders are holding, that exercise price is 80 crores in this example. That means the amount of debt was the exercise price of this call. The market price indicated the total value of assets. So when market price is greater than exercise price, call becomes exercisable. The first case we have seen, the asset value was rupees 150 crore and debt was 80 crore. So what the shareholders choose? They have chosen to pay off the debt and get the remainder. Means if we are relating the debt as exercise price and the value of assets as the market price, MP minus EP, market price minus exercise price, is the value of call. That is what shareholders are getting. Market price resembles the value of the assets and the exercise price indicates the value of debt. So it is MP minus EP. When it is MP minus EP, that remainder was rupees 70 crore. That was the value of the shareholders' wealth in hand. In other words, that was the value of the call option, MP minus EP. And in case the value of the assets fell down, that is down to just rupees 50 crore, shareholders decided that MP is less than EP, correct? We don't want to exercise the option. So value of option became 0. That is why shareholders who were long call, they find the value of the long call as 0. They make an exit, and whatever is the value of asset that is taken over by the debt provider, means you are not exercising the call when the value of the assets is just rupees 50 crore. That is why when we talk about equity, equity is always long call. So I'll just give you a moment to take the screenshot over here as well, and once you do that, we shall definitely move ahead. So the owner of equity is actually owner of the call. That means equity can be considered as call. So if equity is call, what is debt? So basically this line, when I write equity equals to call, it is not the complete line. Equity actually equals to long call. What is debt? So debt is always considered as short put. Now this could be confusing to students when they are understanding this for the first time. Equity is always long call and debt is always short put. So basically you can view debt holders as writer of a put option. And who is holding this put option? The shareholders are holding this put option. How? Let us try to understand this very well. Recall the scenario when debt was 80 crore and assets were 50 crore. Bank expected rupees 80 crore to be paid back, but it actually receives only rupees 50 crore. So there is a loss of rupees 30 crore. In this scenario, who bears this loss? Who absorbs this loss? Obvious answer is bank. It is bank that absorbs this loss. Why bank will absorb this loss? Because shareholders walked away and bank has effectively written an insurance against this default. Means the shareholders were given insurance, not practically an insurance contract, but because of the limited liability feature, it is implied that shareholders won't bear anything beyond the paid up capital value. That's it. That means they will absorb the loss only to the limit of 20 crore total loss that has arisen. assets value fell down from 100 crore to 50 crore, total loss was 50 crore, shareholders are not going to bear that much loss. They will bear loss only to the limit of paid up capital, that was 20 crore. Balance loss will be absorbed by the debt provider or the bank in this case. So if the bank is having need to absorb that loss when the value of the asset falls. So what happens in case of a put option? Put option is exercised when the market value of the underlying falls. When the market value of the underlying falls, you exercise the put option and simply get away. So what is happening over here? That insurance is short put. Who provided this insurance? This insurance in the form of put was provided by the bank. So bank has written this put indirectly, and therefore you should be clear that what is the meaning of put. A put option gives the owner the right to sell the underlying at the specified fixed price irrespective of the market price. When will put be exercised? When the market value falls. When the market price of the underlying falls below the exercise price, the put gets exercised. Allow me to move back so that you can take the screenshot over here. I'm sure you have taken the screenshot. And moving ahead, we would say here when firm's assets are worth only rupees 50 crore, the shareholders are effectively saying to the bank, you take these assets, treat them as a repayment of rupees 80 crores. So that is economically identical to selling assets worth 50 crore for 80 crore. That is exactly what a put option allows. So who owns this put? The answer is shareholders. Who has written or sold this put? The answer is debt holders or the bank. So the bank is short put. Now try to understand one thing. If I ask you, when does put option become exercisable? A put option becomes exercisable when the market price falls below the exercise price. So in this whole analogy of this company where we are trying to apply the concept of options theory to the corporate finance, so we have seen one thing, that equity behaves like a call option, that is equity behaves like a long call, debt behaves like a short put. Now if the debt behaving like short put, we have to first understand this point very well, why debt behaves like short put. So when the assets of the company were falling short, what the debt providers did, whatever was available they took it, and the shareholders were given relaxation of not bearing the loss beyond the paid up value of their capital. In other words, shareholders were having that option in hand. This was in the context of put. So shareholders are not just having long position with put, but they also have the long position with the assets of the company. So when there was just the call, we have found that equity is long call. But when you relate equity with put, equity is not just long put, because with put, if you exercise the put, you will have to sell the underlying. The underlying were assets of the company, correct? So the assets of the company were sold for 80 crore, even though the market price was 50 crore. When can this happen, that you are able to sell an asset at the defined price of 80 crore, even though the market price has gone down to 50 crore? This can happen only when you are holding a put. So if you are holding the put, the counterparty, that is the debt holders or bank in this case, has written this put. So the debt is short put and the equity is long put. But if I say equity is long put, it will be an incomplete line. Equity is long put plus long the underlying. What was underlying? Underlying was the asset of the company. So if I try to conclude this whole matter, shareholders position as a long call, let me summarize this for you. Why shareholders position is considered long call? Because if the assets of the company are greater than the value of the debt, the shareholders choose to pay the debt in full and get the remainder. In that case, we were considering the market price of the asset is greater than the exercise price. What was the exercise price over there? Exercise price was the value of debt. So because the market value of asset was greater than the value of debt, it was as good as holding a call option. And if the market value of the assets, or if the value of the assets fall below the amount of debt, the shareholders will not choose to exercise the option. So market price was resembled by the value of assets, exercise price was resembled by the value of debt. Value of call is always MP minus EP, provided MP is greater than EP, that is market price should be greater than exercise price. If the market price is lower than exercise price, the call will not be exercised and its value will become 0. So either shareholders get value of asset minus debt, or they don't get anything. They will never have to pay anything beyond what they have already paid. In other words, this is as good as holding a call option. That is why we call this as long call. The other aspect what we have seen, shareholders position was a long put plus long the underlying. Now imagine the other scenario, that shareholders are holding the assets, that means they are the owner of assets, and they parallelly have a put option to sell these assets to the debt provider or to the bank or to the bondholders, and at the exercise price of 80 crore. That was the value of debt. So value of debt over here becomes the exercise price, and a put will always be exercised when the market price is lower than the exercise price. Here the market price is resembling the value of the assets, which went down to 50 crore, but shareholders had that right to settle it for 80 crore. That means they are holding the put, and along with put they also are owner of the assets of the company. So if the shareholders are owner of the assets of the company, they are long the underlying, that was the asset of the company, and they are also long the put. Then who took the other position? It was the bank. So bank or the debt, it has a position of short put. So to summarize the whole thing, equity resembles long call and debt resembles short put. That was the end of the discussion. Thank you very much for attending this session with me, and I'll just give you a moment to take the screenshot.